problem of assignment of benefits. And it's really a continuation of a conversation that we had at a table much like this a year ago. And I brought together, I hope, some experts who will add value to the conversation, the dialogue we've been having in Tallahassee and throughout the state on this problem. And let me do some really brief introductions in the interest of time. I won't read the biographies. They are in your materials. I would encourage you to take a look at that. Let me start with Scott Johnson, who's furthest to my left. Scott, after graduating from Stetson University, worked in the Department of Insurance and with the Florida Association of Insurance Agents for 36 years, rising to Executive Vice President. Upon retiring, he's formed a consulting firm and a blog. He's a well-known insurance blogger, follows lots of insurance trends, and keeps track of how things are going in the marketplaces. In the middle here, we have Art Randolph. Art is a senior consulting actuary with Pinnacle Actuarial Resources in the firm's Atlanta office. He's been in the insurance industry since 1998 and has been consulting since 2001. His career focuses on homeowners, farm owners, medical, professional liability, workers' compensation, general liability, commercial and personal, automobile, commercial multi-peril, and construction defect exposures. And then finally, to my immediate left, Robin Westcott. Many of you know Robin. Robin is the Vice President of Government Affairs, Legal and Compliance for the American Association of Insurance Services. As many of you know, she had a long career with the Department of Insurance, Office of Insurance Regulation, and was selected by CFO Atwater to serve as the Florida's Insurance Consumer Advocate. In 2011, she joined AAIS in 2013. And we want to talk about this issue that's been spoken of. I think Barry Gilway very eloquently talked about this being a crisis earlier, and it's a crisis involving an assignment of benefits issue. This is a legal tool in the contract law, largely created by common law legal decisions, that allows a insurance policyholder to transfer some of the benefits, or maybe all of the benefits, of an insurance policy to a third party. The original case is from about 1917, and we may get into a little bit of that later. But I want to set this up in a very practical way, and I want to kind of tell a story about AOB and what AOB means practically, and we'll get some viewpoints and some opinion, I hope, and some facts from our panelists. In 2012, when I was sitting in my office looking at the legislative agenda that we might try to accomplish that year, we were heavily involved in PIP reform. And it was State Farm that came to me and said, we're starting to see a trend that we're worried about in an over-the-horizon kind of way. It's starting off small in South Florida and in Northeast Florida. It's water extractors, it's some roofers. And we feared that this may grow to another PIP-like problem. And additionally, they said, we fear that this, in the event of a significant storm, could be a disaster for the state. So with State Farm's encouragement, we started talking about this issue. In 2012, we had a lot of other distractions, most notably PIP, as I said. But we began to talk to policymakers. We began to talk to our colleagues in the industry. We began to talk to our colleagues in the lobby corps. And slowly, there's been traction on the issue. Now, if you go into a member's office and you talk about this issue, chances are he or she will know what the abuse is like and what the problem is. Where we need some real deep thinking and some sharp thinking, and there are folks in this room who are working on this very actively right now, is on what kind of solution should we try to fashion, if any. And we'll talk about solutions in the legal area, in the regulatory area, and in the area of statutory change. But let me set this up. Monty Stevens, in a presentation last week to the House Insurance and Banking Committee, was asked about AOB and whether it was a problem, and I loved what he said. He said, well, typically what happens is it's 3 o'clock in the morning, and you go into your kitchen, and you're looking for a glass of milk, and there's 4 inches of water on the floor. And we sort of smiled at the back of the room because not just us, but many of us in Tallahassee have been saying that same thing for at least 3 years now. So let me set the story up. It's 3 o'clock in the morning. You come downstairs, you go into your kitchen for a drink of water, and you find 4 or 5 inches of water on the floor. As anybody, you would panic. If you know how to turn your water off, you've turned your water off pretty quickly. The second thing you're probably doing is you're on the phone with your insurance company, or you're on the phone with your plumber, or you're on the phone with a water extractor. If you see billboards or if you look at the yellow pages, if you still have those, there'll be lots of advertisements for water extractors all over the state of Florida. And this water extractor will come to your house and say, Ms. Westcott, here are several forms I need you to sign. Let me take a look really quickly at your insurance policy, and everything will be taken care of. So naturally, Ms. Westcott signs the forms and says, great, let's just take care of this, get this water out of here, I don't want mold. Unbeknownst to her, she may have signed, or the vendor will argue in court anyway, that she has signed away the rights that she has under her own insurance policy. Unbeknownst to her, that vendor may try to assert that he, or the vendor, or she, is the policyholder for purposes of that claim, and that Ms. Westcott is to be basically ignored and to be cut out of that transaction. This is something we're very, very deeply worried about as insurance companies because we want our insured in the center of the transaction. So this can go two ways. The first way and the best way and the most common way is the water extractor talks to the adjuster, talks to Ms. Westcott. There's an agreement about what kind of covered loss there is. There's an agreement about what the vendor has done in terms of price. Everybody gets paid. Her kitchen is restored, and she's back to normal. But we're not going to talk about that today. We're going to talk about the downside scenario. So what I'd like to do is go to Scott Johnson and have Scott kind of talk a little bit about what an AOB is, and particularly with some focus on what the negative, what the downside of AOB abuse is, and then we'll have some conversation around that.
Okay, what AOB is, first of all. Just let me say, if I'm given the definition, that this is going to be the layman's definition of what assignment of benefits is. We've got a great actuary and an attorney here on the panel, so they can fill in the details and the nuances from a legal standpoint. But basically, under Florida law, an insured, a policyholder is permitted to assign the benefits of their policy on a post-loss basis to a third party, usually an emergency remediator of some sort in property insurance. The concept started originally with medical billing. It migrated into personal injury protection. There was a case in 1995 that said that the assignee, the third party receiving the benefits or the proceeds of the policy, is not also responsible for performing the duties of the insured under the policy. Another case, State Farm versus Shaw, a number of years later, affirmed that decision. And with those two decisions, the concept began to take off in the property insurance realm. One of the insurance companies that I spoke to, after my first blog, I got a bunch of calls, told me that in 2010, it had less than 30 assignment of benefit claims, or less than 30 claims involving AOB. In 2011, it had 120. In 2012, it had over 400. That's a 1,300% increase in 3 years with basically the same number of policies in force. In 2013, it had 1,500 AOB claims. And in 2014, it began to seriously look at addressing the problem of assignment of benefits within its book of business. As Michael said, there's really two perspectives with AOB. One is the attorney or the trial bar perspective, and the other is reality. To an attorney, AOB is simply a contract that allows the contractor to step into the shoes of the insured and receive payments and file suit, receive payments direct from the insurance company and sue the insurance company. The reality is that the insured has given up control of their claim. They don't get paid directly. The carrier is often forced to pay unreasonable amounts, fraudulently inflated claims. Even the equipment sometimes with water extraction is manipulated to make the claim seem worse and inflate the costs of it. The contractor can place a lien on the policyholder's property. In Florida, a mechanic's lien ultimately carries with it the potential of foreclosure. So there's tremendous pressure on the insurance company for that reason, and ultimately for a bad faith lawsuit, to just pay the claim when they get the bill, even though they didn't even know that there had been a loss. The AOB company sues the insurer, not the insured, to force payment. And a good example that I was given after I posted my first blog was a 1,500 square foot home would be normally between $3,500 and $5,000 to completely remediate, extract, and dry the entire home. But for an assignment of benefits claims, it averages in excess of $10,000 for the same loss. Carriers consistently tell me that about 20% of their water extraction claims are handled via assignment of benefits, and that the average indemnity is 35% more for those claims. Representative Santiago just did an op-ed in the Tampa Tribune showing where he stated they're triple that of normal claim. Well, the average is, what I'm hearing, is around 35% higher. The Division of Insurance Fraud is currently handling over 100 cases of abuse, investigating 100 cases of abuse for assignment of benefits in just the Tri-County area of Hillsborough, Pinellas, and Pasco counties. That's not even Dade County. They've got 100 of them in that area. So it allows the claim to be kidnapped. It abuses the insured, and it is the enabler and the incentive for all sorts of fraud. And I'll close with this one example. I posted a blog a little while ago, and a water extractor from Tampa called me. Said, you know, you're right on with what's going on in the water extraction business, and really loved your blog, but you really only scratched the surface. He said, one of the big problems is plumber kickbacks. So I said, well, what do you mean by that? And he said, referral fees. He said they're paying plumbers who are the first ones on the scene. It's usually not the water extractor.
Right.
$1,500 just to refer the case to a water extraction company. So I was a bit incredulous. I began calling water extractors all over the Tampa Bay area and pretending to be a plumber. The very first one I talked to said, what kind of referral fee you pay? I'm fixing my mother-in-law's leak. Yeah. And he said $1,500. I called the next one. The woman who answered the phone knew the answer. She said, we pay $1,250 depending on the size of the loss. We can pay more. The third one I called said, we pay $1,000. And naturally I said, well, how come you don't pay $1,500 like all the other folks? And her answer was very telling. She said, you know, I don't know how they do it because you got to cover the deductible too. So what they're doing out there is they're inflating the cost to cover a $1,000 deductible and a $1,500 plumber's fee, and the insurance company comes in $2,500 in the hole. Figure that across the entire spectrum. 3% of 6 million policies file a claim every year. Half of them are water losses. Half of those might involve a plumber, and half of those are AOBs. And you're at $20 million a year just to cover the deductible and the plumbing referral fee.
That's amazing. That's amazing. Let me turn to Robin, who in her capacity as insurance consumer advocate in 2013 formed a working group to look at policyholder property insurance claims. And they had testimony through the summer, I think, of 2013. And part of the testimony, part of the discussion was on this very problem. And Robin, we'd love to hear your experience with the working group and what you may have learned, what was talked about, and some of your ideas about the nature of this problem. And then we'll come back around in a couple minutes to talk about solutions.
Okay. First of all, thank you for the invitation to appear today. I appreciate that. The first time I heard water as a problem was probably rooted somewhere in the history of being the chief financial regulator with OIR for property and casualty. And we worked on a number of issues throughout my tenure. You've heard the CFO mention this morning, PIP and sinkhole. We did the sinkhole study when I was the chief regulator. So you've got to real familiar with your industry and what they were saying about their losses. And I remember vividly after we talked about PIP, going up to the commissioner at one of these events after I left the office and said, water is your next sinkhole. Well, by God, it was quoted next year in the legislature. I'm like, I am an oracle. But, you know, that was the first, and so that was kind of the first knowledge of that. But when we saw that a lot of these things were having a severe impact on consumers, because the reality is, while we license and we regulate and we make first responders in every other sense of an emergency, where it's an emergency across our community, we make those people be licensed and really are incredibly strict about who can do that and the things that can be taken out of context with you know, the cost of materials and things that can be inflated. We don't do anything about people who do go out in the middle of the night and respond to the plumber that goes and fixes that leak or whatever's happening. And quite honestly, for that person in that moment, it's a crisis. It's a crisis that affects their most valuable possession most times is their home, and especially in our state where you have so many elderly, that is their retirement. Their home is primarily going to be one of their greatest assets in their estates. And so protecting that is very dear to many of our Floridians, but especially into our senior population. What I saw when we did the working groups throughout the summer, I went all over the state, and then I did some roundtable discussions. I only do that because I really like being on the Florida channel late at night. You can still see my reruns of some of those now. We found consumers, and they were very forthright with what they were telling us, and most of the time it went along the lines of, I don't know what to do. My company won't pay this claim because they say that, you know, this person has done more in my home than was necessary, or they're charging for things that I don't even know if it got done or not. I just want my home fixed. I just want to be back in the place that I was before this event in my life happened. And there were varying degrees and some incredibly powerful moving stories from people where their life was disrupted for years in this process, for more than a year, for, you know, a claim settlement that should have been easy. It should have just happened. And many of you, if you've had a claim, an insurance claim, you've had good experiences where you were fixed, you were made whole, it just went away very quickly. But this was not, and this was a nightmare that people were living in. There was one family that they basically had to take a rental and move out of their home because the damage, what had happened was the remediators came in, and lo and behold, the next thing you know, half their walls are gone. Had to be replaced because there was water. And so at some point, when the insurance company goes in to adjust this claim properly, and there's the assignments there, you have all these circumstances where the family couldn't live in their home, they're displaced, and they're caught right in the middle. The other, to me, completely obnoxious practice was for once those assignment of benefits were in place, or for the contractor, for whoever had done the repairs and took the assignment to say, well, your insurance company isn't going to pay this. I'm going to put a lien on your home. That is catastrophic, especially in a situation where, and this particular couple was elderly, and that was heartbreaking for them. They worked years to pay off the mortgage on their home, and to think that now there was going to be a lien against their home for this type of thing. It was an incredible tale, and so the consumer really, what we found was the consumer was caught in the middle of this battle, and so I think for whatever solutions we discuss later, we really have to be cognizant of the fact that they are your insureds, and they are kind of caught most times in the middle. They're oblivious to the fact of what they've just signed, and I know that sounds, it sounds like, well, you should read what you're signing. I'm a lawyer. How many of you have read your insurance policy? Yeah, you, the actuary. But many of us, even as lawyers, we don't stop and we don't read, and especially in a crisis situation. In a crisis situation where you're older and you just want to have this fixed, and the stress level is just overbearing on you, you'll sign anything to get your house fixed. And that's what we were finding, and these people were really caught in the middle. I'll go on to say, just from the experiences of working in that working group and having the discussions with all the parties, you know me, I haul everybody in and say, what's your angle, what's your angle? There was actually a lot of consensus around the table about this issue from many sides of people who are involved in the claims process. And it was a little surprising to me we couldn't make more progress on the issue. I'm sorry I bailed on you guys before that one went to the legislature last year. I think that here's my greatest concern. Because I am so sensitive to catastrophic risk in our state, and because I understand what happens when a situation can and will be manipulated by one party or another, our overall exposure in a CAT situation, what is that going to look like when half of the shingles are peeled back off somebody's roof and there's water intrusion into their home, and we have a bunch of people who have learned to exploit this type of claim? what does that risk look like? That's scary. It could look a lot like a sinkhole risk did to us before the reforms. So that's the kind of thing that I think the discussion ought to take is you have homeowners caught in the middle. We are still exposing ourselves with a risk that's, something we see in the everyday claims process, but what is that going to look like in a catastrophic event?
I think that's a very important point, and we'll talk a little bit about some solutions. I'd love to hear some of the ideas that may have been in the recommendations that your working group developed. And before I go to Art, I want to tell a quick aside about the numbers. I know Scott talked about numbers. Art is a numbers person, obviously. I did an op-ed, an editorial board meeting, excuse me, with a well-known Florida newspaper whose headquarters is very close to where we are right now. And I prepared all this stuff about citizens and depopulation, and I thought I was an expert on that, so I had this literally a notebook. And then I had this whole notebook on PIP and all the issues we were having with PIP. And there were 3 guys in this meeting, and we were talking, my colleague and I was very passionately talking about citizens and why we need to reform the process by which citizens takes on risk, and we needed to shed risk, et cetera. They sat here with their pens on their notebooks, on their pads, didn't take a note. I talked a little bit about PIP and what was going on in PIP, and they may have taken a note. Then he literally, he figuratively rather, brushed aside all this material I had. He said, why aren't homeowners rates falling? We haven't had storms in several years. And there are several answers, of course, to that question. But one of them is that there are these non-cat claims which are increasing, and this is what Scott and Robin have talked about, and this is the most important thing that we're trying to do in this endeavor is to get our arms around that cost increase, and at the same time to restore the relationship between the insured and the company to keep them in the middle of the transaction. So Art, you represent several Florida domestic companies in your practice. Tell us, if you can, what you're seeing, what they're seeing, what your experience is, and any analysis or any numbers that you may have that can help shed some light on where this problem is going.
Sure. I was actually encouraged to hear Robin, well, not encouraged, that maybe that's the wrong word. But it's interesting for you to align it with sinkholes, because in the actuarial community, we kind of look at it as that next emerging risk, that non-cat emerging risk. And I want to kind of amplify what Scott had said, that water claims, just if you put aside the AOB issue, water claims represent about 50% of all claims, of all homeowners' claims in Florida. So if you're talking about a population of claims that are rooted in the water peril, that are now suffering through or now going through increasing loss trends, increases in cost to defend those claims, you can only imagine what kind of ramifications that has on not only the rates in Florida, which I think a lot of people have questioned about why the rates aren't going down, but even kind of the more silent killer that people aren't necessarily focused on is the amount of claim liabilities that these property carriers have to have on their balance sheets, because that's becoming an even more intricate analysis of trying to determine how to assess this ever-emerging risk. I guess there's a couple of ways to think about this. Scott had already mentioned that water claims with these AOBs are 3 to 4 times higher than your traditional water claim that doesn't have the AOB assignment to it. The other angle of it is that these are kind of legal claims as well, because there's a lot of dollars that property companies are expending in defending these claims. I have clients of various sizes, and I think all of them have different philosophies about how they address these claims. Now, notwithstanding the 100 claims that Scott had mentioned that are currently being investigated, but I think the way the approach is kind of twofold, or kind of falls into one of 2 camps. Either one, the claims come in, and the idea or the understanding is the financial results. How to best keep our financial results within line. And for some folks, the easiest way to do that is just to pay the claims, get them out of the way, unless they are certainly the most egregious claims that certainly warrant further investigation. So you have one camp that subscribes to the philosophy of let's just pay them and get them out of the way. Some of the larger carriers that kind of want that messaging out in the community to say that we are not going to just pay these frivolous claims, will expend the defense cost and those defense dollars to defend those claims pretty vigorously. From a financial perspective, and there's been claims in the past where if you vigorously defend them, you have higher defense costs, but then you have lower indemnity costs. But with these AOB claims, the 2 don't necessarily go hand in hand. There's often times where you're paying more in defense dollars and you're also paying more in claim benefits. And we can talk about this later, but really what does that look like for homeowners' rates and for the reserves that a lot of these property companies have to carry on their balance sheets?
We talk about the legal fees, and I'm aware of a case from South Florida that was on appeal to the circuit court. It was a county court case. I think it was a $7,000 or so dispute, water claim. Prominent law firm that does water claims was the claimant's attorney. And the claimant prevailed by some amount. It wasn't $7,000, it was much less than that. The claimant, of course, then sought attorney fees under the one-way fee statute, which is a perennial problem for our industry, and we're going to talk about that in a second, and went to the judge and said, okay, we need our fees paid. The judge said, what were your fees? Well, $500,000, Judge, which the judge had said. I mean, obviously there is some analysis, but he approved that order for
This
fees.
pattern's very strikingly similar.
Sounds like Pitt, in the amount of $500,000 over roughly a $7,000 claim. So, and it won't surprise anybody in this room that in the insurance industry we have several viewpoints on how to solve this problem. There are some very sophisticated approaches, and there are some legal victories out there at the trial court level that are favorable for our industry. So I'm going to turn it over to the panel in a second, but let's talk about a couple different schools of thought. Number one, do nothing. There's litigation advantages for us to do nothing because we're winning in some of these cases. Number two, get an AOB statutory change that clearly and I'll use the word purely resolves the problem in our favor. Right now the statute says a policy may be assigned or not according to its terms. A simple change to that could be a policy or the post-loss benefits from the policy may be assignable or not according to the terms of the policy. That would allow companies, frankly, and consumers and the marketplace to decide whether they want to have AOBs or not. Some companies would say, no way, we're not doing it. Some companies may say, we're willing to do it. Our business model will let us do that. There's another approach, which is a great approach as well, which gets at the attorney fee issue. And it says, look, take the incentive away from that third-party claimant to leverage an inflated claim with the threat of attorney fees using the one-way fee statute. I love that idea. That's an idea we've been talking about for years. And some would say, it cuts the head off the snake because it gives incentives across the board in the claims area for folks to misbehave. And it creates this wonderful moral hazard for the insureds who don't have to worry about paying their own attorneys, or the claimants who don't have to worry about paying their own attorneys. There's a variation on that which says, look, if you do an assignment and the assignee is a business entity, that business entity shouldn't have the right to one-way fees. The one-way fee statute is designed to create some balance between the Davids and the Goliaths, the individual insureds and the large insurance companies, historically. There's another school of thought that says, let's just touch the insurable interest statute. Kim Salmon's sitting right here, and she's been working on that diligently for the last couple of years. And let's make sure there's not some unlawful public adjusting by virtue of the assignment. So there are several different viewpoints, and I want to turn it back over to Robin. Maybe we can lead with Robin, and we'll go to Scott and Art, and just talk about, these are just some of the ideas. You have some ideas probably. You each may have some opinions on this. I'd love to have them. We're going to try to save 5 or so minutes for questions. I hope maybe there's some questions for the audience. So we've got about, I'm going to say maybe we have 10 minutes left. So let's go ahead and talk about solutions.
Okay. We went through a lot of the potential changes, and obviously there's a case now working its way through the First District Court of Appeals directly on the issue about the assignments and language that policies can have. I obviously follow that with great interest since I write policies now for a living. First of all, I want to say, there are probably no wrong answers. There are probably moderately right or nominally right answers. But I can tell you this for sure. When we were talking about underwriting cycles earlier in the day, I can tell you for sure it is only a matter of time before the business cycle will adjust, adapt, and exploit whatever the next thing is we do. And so when you're looking at will that be attacked, it's not a question of will it be attacked, it's when will it be attacked, okay? That's right off the bat. And so I think whatever you do, you kind of have to balance against the thought process that these are some of the obstacles that you're going to encounter when you're trying to fix anything in a statute, fix anything with policy language. I personally like fixing things with policy language, but that can only be coupled with good education and good information coming from the agents and at the purchasing point about what the product is and what it does, sublimits, those types of things. And I also say that, we talked earlier, and Barry had said when he was up here about Citizens starting a remediation type program where there are companies that already do that. Here's my concern with that. There is a great deal of focus now at national, international levels about, and not just in the insurance arena, but enterprise risk management, how well you understand the risk you're taking in your business, what you're fundamentally doing. And if we start opening construction businesses and start running other things, it really distracts us from our business, which is writing insurance. And I am very, very concerned that we have not thought through with some of these, with doing some of these things, what real risk we're bringing into our companies when we do that, when we choose to start another business, basically within our business. How is that really affecting your enterprise risk management? How is that affecting your business in the sense of you're now focusing on something that is not what your primary purpose or your goal or what you started your company to do? I don't believe that people can't do it well. It can be done well. I've seen a couple instances of it not done well. Fundamentally, I didn't see a lot of consumers out there that when it happened to them that it was all that great of an experience for them. But they did get some resolution. But I'm concerned with that aspect about moving in a different direction, one other than being underwriting risk, which is what we do, as an insurance company, as an insurance industry.
Scott.
Well, I think one thing is the consideration of the Security First insurance company lawsuit that's currently in the first DCA. What Security First did was file for a form change that said that an assignment of benefits is only valid if approved by the company. Right. And OIR denied that, and a 120 hearing officer agreed, and now it's at the first DCA, and a decision will be out probably the day after the legislature adjourns. But I think it's important that we understand how that case comes out and what the judge's decision says in formulating what we want to do either in this session or in a subsequent session should we decide to not do anything during this session. The statute that you quoted that says a policy's benefits can be assignable or not depending on the wording of the policy existed at the time that OIR denied Security First form filing because they used the form filing statute, which says that despite what the rest of the statutes might say, you can't have anything that's misleading in your form, right. And that was the crux of there. So we would have to address that statute as well, in my opinion. But in the meantime, what do we do while all of the industry is sorting that out? First thing is, I think insurance companies need to begin to do all they can to direct their policyholders and their agents to providers that do not use assignment of benefits. 80% or so of the claim, 70% maybe, there is no assignment of benefits, and those people are just as happy as they can be with their claims and the remediation that they receive. Mm-hmm. There are many insurance companies using specific programs that not only encourage that or restrict it. You must use this particular provider. Mm-hmm. You can pick another one, right. But we're only going to pay as much as this provider paid. Carriers may have different levels of comfort in doing that, but that's something I would encourage them to do. And get your agents to also recommend a provider that does not use assignment of benefits, doesn't pay plumber referral fees, and guarantees their work. A legislative fix that would go a long way, prohibit plumbing referral fees. Mm-hmm. Last year, you prohibited agents from getting a referral fee for recommending a wind mitigation companies. Right. Well, darn it, plumbers ought to refer business based on the service and the price and the reputation of the company, not because they're being paid $1,500 to do so. That'll cut into the problem a great deal. And the third thing I would say is let's implement some of the reforms from Robin's task force regarding the water extraction business. It's largely unregulated. They ought to meet the IICRC standards.
Right. That was
and-
shocking to find out. There are really standards out there, and most people are using it. It reeks of fee schedule, which is could be a dirty word from PIP.
Right,
but,
right.
And again, the problems that come and arise from
That's right.
doing that sort of thing.
And have the licensee doing the work, not the apprentice or somebody they just send down there to get the AOB signed and so forth. Those recommendations would go a long way, regardless of what we might do with assignment of benefits. So, Art.
I won't overstep a line and talk about what different policies should be implemented or which ones are most practical. I will speak to one that just as an actuary, just pure insurance just seems kind of impractical, is the do-nothing approach. Reason being is, again, if we kind of talk through separating out water-type claims and non-water claims, the non-water claims, you know, the inflationary pressure on them is that they're increasing about 3 to 4% a year, which kind of makes sense. I mean, it kind of goes with the economy, kind of goes with housing market values.
Yeah.
But water claims are rising at about 6 to 7% per year. That's not a sustainable clip. The underlying or kind of the groundswell is really what kind of implication does that have on insurance rates? I think we all realize that even if an insurer said that, well, I really need 10% to make this right based on these water claims and other type of perils, they may not have great success in getting that through the OIR. And that's no slight on OIR. I mean, it's just not good public policy. But if you have a type of loss that's running at that kind of clip that you just can't keep up with, then we're potentially talking about what kind of solvency issues does that create for insurance carriers. And that might be my primary concern, is what does that have on the, what implications does that have on the back end?
I'll make one other comment. I think something everyone in the room should consider and think about. The industry still, and part of the reason I did a lot of the working groups and worked on the issues that I did, collectively we aren't good. The industry is not good, and I would have said this from the other side of the table. You aren't good when I was with the office at really leveraging the data that you have. You know, collectively, you all have a lot of information on certain things and however it's being captured in your systems, but collectively putting that together and making a story, an argument, numbers and things that cannot be disputed, those create policy change. We saw it with PIP. It was only after we had real numbers that kind of showed where the cost drivers were in that system. Sinkhole, same thing, the sinkhole data call. I'd like to see us move from the, oh my God, data call, let's see if we can figure out where this is coming from and what it's affecting, to a little more collaboration and really looking at, as Julie was talking about in the auto industry and what they do, Hildy does, and the collection of data. I think we should be moving toward that in the other P&C lines, to have collection of data, so it can be, this type of thing can be leveraged, and your data can be leveraged to tell your story.
Well,
Go ahead.
I was going to say, to Robin's point, I mean, that's kind of one of the struggles that I have, is I'd like to be able to quantify everything that I just said a little bit more finer. But even talking to a lot of my clients and doing kind of implicit data calls to non-clients, they know about these claims, they have kind of an intuition about these claims, but they don't flag these claims
That's right.
in their claim system. So when you say, okay, give me a data run or data dump of all your AOB associated claims, they can't. And I think that that's going to be part of what would actually help move that effort forward to try to resolve some of this.
That helps you fix not only this problem, but it helps us go through the metrics of seeing what the next problem is going to be. Because like I said, the cycle is, it only takes a certain amount of time before it's manipulated, and the gaps or the places where it could be exploited are found. You need to know that before. You need to see these problems coming before, so the fixes are more immediate.
One last thing for Scott, and then I think we need to wrap up.
Just one comment, and I will preface this by saying that whenever I start talking about numbers and stuff like that, the suicide rate for actuaries goes way up.
Seems very calm right now.
But we know that 55% of the claims out there, non-cat claims, are water. And we know roughly what the percentage and the cost of all of that is that's driven by fraudulent claim inflation from assignment of benefits and plumbing referral fees and making up the deductible and so forth. And that's the non-CATS side. It's the most significant cost driver out there.
Yes, it is.
But it's also on the CAT side, and we forget about that, I think. Reinsurance allows for, think what happens after a catastrophe? Well, everybody's got the roof blown off. They need to have the water extracted. It's in virtually all of their houses. And there is a factor, though not always quantifiable, in the reinsurance premium that goes to cover that cost. It differs based on the insurance company and how their SIU unit works and how they manage their social inflation costs from litigation and public adjusters and so forth.
Right.
But it's in there. When you add those two things together, that could have a material impact if we could address that problem of getting Florida from being the highest premium in the United States to something a bit more reasonable. So whenever I hear a presentation, somebody says, what's the biggest cost driver? And they say, well, reinsurance. It's
Right.
40% to 60%. Well, a portion of that reinsurance fee is going to pay for stuff like this, in addition to the CAT side,
Right.
non-CAT side.
We want to continue this dialogue. If anybody has any questions, please find any one of the panelists off stage here, because our time is up. I want to thank Scott, and I want to thank Art, and I want to thank Robin for making themselves available and having this conversation. Obviously, we need to keep talking about this. We particularly need to keep talking about this in the halls of the Capitol, and we need to find a solution that we think we can land on and hopefully get something clear that will resolve to our benefit and the benefit of all of our customers in this marketplace. So thank you for your attention. Have a great afternoon.
Thank you. Thank you.